One of the biggest mistakes investors make in commercial real estate is assuming that fast-growing brands are automatically safer investments. But sometimes rapid growth is exactly what should make you nervous. Because when franchise concepts expand this quickly, a lot can start breaking underneath the surface long before investors see it in the numbers. Operational strain, weak franchisees, bad site selection, declining unit economics, and consumer hype that fades faster than the lease term you're underwriting. Welcome back to the Commercial Real Estate Deal Room. In the last video, we talked about why investors are so excited about 7 Brew right now, the growth, the momentum, and why drive-through beverage concepts are attracting so much capital. But today, I want to focus on the hidden risks that many investors completely overlook when evaluating fast-growing franchise brands. Because here's the reality. The lease only works if the business works, and the business only works if the unit economics work. So today, we're breaking down the risks behind concepts like 7 Brew and why sophisticated investors need to look far beyond the cap rate and the marketing package before making a decision. Hi, I'm Mercedes Shaffer, commercial real estate broker, business broker, and the agent who's going to tell you what most others won't. Because my goal is to help you understand exactly what you're buying, not just what's on the glossy brochure. So let me start by saying fast growth is not inherently bad. In many cases, it's a very positive indicator. It signals consumer demand, investor confidence, and brand relevance. And all that matters. But here's what investors often overlook. Rapid expansion puts enormous pressure on franchise systems. And the faster a brand scales, the harder it becomes to maintain consistency across every single location. Think about what happens when you go from a few hundred locations to 670 locations across 38 states in just a few years. Suddenly you have more franchisees to train, more supply chain complexity, more operational variability, more leadership bandwidth being stretched, and more pressure to maintain unit economics at every single location simultaneously. And this is where things can become vulnerable in ways that don't show up in the marketing materials. Because the question is no longer, is the brand popular? The question becomes, can the brand scale without weakening? Can every franchisee in every market maintain the quality and throughput that made the concept work in the first place? Historically, we've seen many concepts struggle with this exact same issue. Brands that looked unstoppable at 100 locations but started deteriorating at 500. Concepts that franchised aggressively only discover that not every franchisee could operate at the level the brand required. We saw versions of this with brands like Krispy Kreme during its rapid expansion years, and even with chains like Subway, where aggressive unit growth eventually created oversaturation and inconsistent operator quality in many markets. Because scaling a concept and sustaining a concept are two very different things. Now, I'm not saying that's the path 7 Brew is on, but it is something every sophisticated investor should think about carefully, because enthusiasm can sometimes cause people to stop asking the harder questions. And those harder questions are exactly what separates a smart investment from an exciting one. And this brings me to a distinction I think is critically important for any investor evaluating a franchise concept: the difference between a hot brand and a durable brand. Hot brands create excitement. They generate lines. They trend on social media. They attract franchisees who are eager to get in, and they generate a lot of investor interest in the real estate. Durable brands survive economic cycles. They hold up through recessions, inflationary periods, labor pressure, shifting consumer behavior, and increased competition. They prove their relevance not just in year 2 or year 3, but in year 10 and year 15. And those two things are not always the same concept. Starbucks has proven over decades that it can adapt and endure. It has survived multiple recessions, significant competitive pressure, labor challenges, and massive shifts in consumer preferences. That's durability. And that's why Starbucks real estate commands some of the lowest cap rates and highest prices in the entire QSR space. 7 Brew is still much earlier in its life cycle, which creates genuine upside because you're potentially buying in before the brand's durability is fully priced in. But it also creates real uncertainty because investors who buy a 10-year lease today are not underwriting the next 6 months. They are underwriting long-term consumer relevance. And that's where the analysis needs to go much deeper than the growth headlines. The coffee and beverage category is particularly competitive. Dutch Brothers has established a strong cult following and is further along in its institutional maturity. Starbucks continues evolving and new concepts are always emerging. So the question I would be asking is, what is 7 Brew's substantial competitive moat? And is that moat strong enough to hold up over a decade? Now let's talk about what sophisticated investors should actually be monitoring, because I see too many people focusing on the wrong metrics when they evaluate deals like this. The growth headlines are not what matter most. What matters is what's happening underneath the growth. Are individual locations performing well? Are same-store sales growing? Or are they being diluted as more units open in adjacent markets? Are franchisees profitable after covering rent, labor, food costs, royalties, and debt service? Are their locations quietly underperforming while the overall unit count keeps expanding? And here's one of the most important metrics I would want to understand for any franchise investment: the rent to sales ratio. A healthy franchise operation generally wants rent to represent somewhere between 6 and 10% of gross sales. At 6%, you have strong coverage and financial flexibility. At 10%, you're at the upper limit of what most franchise systems can comfortably support over time. Now, we don't have publicly disclosed AUV data for 7 Brew, and part of what I do when I'm working with a buyer on a deal like this is I go deeper into any available financial information through the due diligence process. If the lease includes a sales reporting requirement, my client and I would sign an NDA and review the financials directly. That information stays confidential. I wouldn't share it here, but it becomes a critical part of how we evaluate whether the business can actually support the rent long term. And this is exactly the kind of work that separates a well underwritten investment from one that looks good on paper and creates problems later down the road. Now, with all of that said, let me be equally honest about what this deal does well, because there's a reason sophisticated investors are paying attention to it. The structure itself is genuinely attractive. This is an absolute triple net ground lease, which is about as passive as commercial real estate gets. The tenant handles taxes, insurance, and maintenance. As a landlord, your day-to-day management responsibility is essentially zero. And for investors coming out of multifamily, that simplicity has very real value. The lease runs for 10 years with 10% rent increases every 5 years in both the primary term and the option periods. And there are 5 additional 5-year renewal options. That's a long duration asset with built-in income growth. Rent that grows beats flat rent every single time, especially in an inflationary environment. The location is in Texas, a state with no income tax and strong long-term economic fundamentals. The growth corridor is legitimate. The surrounding retail cluster is strong, and the consumer behavior driving the drive-through category appears durable rather than purely trend-driven. So what's happening here is that investors are buying a combination of things: the real estate fundamentals, the lease structure, the location quality, and yes, the brand momentum story. And that story, if it continues to play out, could make this a very strong long-term investment. But the brand story is the variable, and that's what investors need to price carefully. So here's my read on where this deal stands. I think this is a more interesting investment than many traditional legacy QSR opportunities. The structure is clean, the location is legitimate, and the brand is aligned with consumer trends that appear to have real staying power. But I also think investors need to stay disciplined and avoid getting swept up entirely in the excitement around rapid expansion, because some emerging brands become category leaders and some don't. And right now, investors are still figuring out which path 7 Brew is going to follow. So my view is this: If you are an investor who believes strongly in where drive-through beverage culture is heading, if you like the Texas growth story, and if you understand that you are buying a newer concept with real upside and real uncertainty, then this deserves serious consideration. But if your top priority is maximum long-term stability above everything else, if you need to know that the brand will absolutely still be relevant in 15 years, then you should probably be looking at something more proven, and you'll likely pay a lower cap rate to get that certainty. The deal that best fits you depends on what you're actually trying to accomplish, and that's a conversation worth having carefully. In the next video, I'm shifting away from the brand entirely and focusing on the real estate itself, because this location in Decatur, Texas is actually far more interesting than most investors probably realize at first glance. And the location story may be the most underappreciated part of this entire deal. If you're actively evaluating triple net investments like this, or trying to think through emerging franchise concepts more strategically, my contact information is in the description below. I'd love to connect and walk you through what this type of analysis looks like for your specific situation. Thanks for watching. I'm Mercedes Shaffer. This is the Commercial Real Estate Deal Room. I'll see you in the next deal.